Yo, so I found 3 videos of Scott Bessent, the Secretary of the Treasury, talking about the markets and the economy. And it's pretty obvious what their motive is. And they're not here to save you. Just listen.
If we ever went down 20% on the NASDAQ or 15% on the S&P, with people that want Trump to fail, that's going to be splayed across every newspaper in the world. I'm just wondering whether the tolerance for something like that for the administration.
Well, look, as you said, Joe, the market was up 20% last year, 20%
So there
the
is
year
some
before.
house money.
No. I'm going to put it another way.
Okay.
Did the Biden administration succeed? The American people weren't buying it just because the market was up. They voted out. They voted out the Democrats.
Question related to the regular.
So, who is Scott Bessent? He worked with George Soros to break the Bank of England. Just, some background when it comes to his character and who he is. He's not here to help you, okay? That was just one of the videos, okay? Let's bring up the second one.
Top 10% of Americans are 40 or 50% of consumption, and that is an unstable equilibrium. The bottom 50% of working Americans have gotten killed. We are trying to address that. We're trying to get rates down, and could we be seeing that this economy that we inherited starting to roll a bit? Sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period.
What is detox? Obviously, that's a recession. Okay, next one.
I think over the medium term, which is what we're focused on, it's a focus on Main Street. Wall Street's done great. Wall Street can continue to do fine, but we have a focus on small business and the consumers. So we are going to rebalance the economy. We're going to bring manufacturing jobs home.
Then we go on CNBC. Treasury Secretary Bessent says there is no Trump put, but their policy should boost market. Investors looking for President Donald Trump to use policy to stop the stock market from falling are likely to be disappointed. Treasury Secretary Scott Bessent said Friday. What a lot of people don't get, and they're always talking about QE, the Fed, the Fed, the Fed, the Fed. I've gone over this plenty of times. We can just do it real quick. Here's the 2-year yield, okay? So this is the 2-year treasury yield in the bond market. If I overlay the Fed funds rate, right here, what you'll see is that one of the lines move first, okay? And it's the regular candles, okay? In this case, the red line is the Fed funds rate, overnight lending rate set by the central bank, in this case, Jerome Powell, right? So you might think that they're very sophisticated, all the people working at the Fed and so on. They have 785 PhDs there, but you can clearly see here, just based on looking at this, that when the regular candles move down, the red line follows. When the regular candles go up, the red line follows. Which one goes down first? The regular candles. Which one goes up first? The regular candles. Which one goes down first? The regular candles. Regular candles again, regular candles again. Regular candles first, regular candles first, regular candles first, regular candles first. So it's not Jerome Powell that controls interest rates. So how are interest rates actually managed? Well, it's supply and demand in the treasuries, right? You buy the treasury and the price goes up, the yield goes down. So why would interest rates come down? Well, again, it's about growth and inflation expectations. If people in the bond market, not normal people, just billionaires in this case, who have the ability to move these interest rates, are seeking safety and liquidity, and they're trying to move the counterparty risk from the banks to the government, and they buy treasuries that pushes down the interest rate. So lower interest rates tells you that billionaires are concerned about the economy. They're looking for safety and liquidity. They are not concerned about growth and inflation. Well, in this case, it's not about being concerned. They are not expecting growth and inflation, right? So the opposite of that, potential contraction, and if it gets bad enough, maybe some deflation, right? Inflation is good for the economy, you just don't want too much of it, right? The second thing I want to go over is the Fed's balance sheet, which everyone is talking about, but no one understands it. Okay? No one understands this at all whatsoever. Let's delete this. Since 2015, right? So we're going back the past 10 years. Since March 2015 to March 2025, the central bank in the US has expanded their balance sheet by 2.2 trillion. Let's round up, 2.3 trillion. During that time, US GDP in trillions 2025. US GDP is 30 trillion. Market cap to GDP at the peak of the market was at 207%. Okay? So that's roughly a $62 trillion stock market. 61, 62 trillion. Just to bring up a comment from Warren Buffett, which, first of all, as I said in my last video, in a Fortune magazine interview back in 2001, Buffett referred to it as probably the best single measure where valuation stand at any given moment. Then he said this in an interview as well. 1 year after the dot-com bubble popped, Buffett said that the unprecedented highs should have served as a strong warning signal. If the ratio approaches 200%, as it did in 1999 and a part of 2000, you're playing with fire, said Buffett. Well, we just hit 200% there. So you're playing with fire, according to Warren Buffett. And keep in mind that he has Berkshire cash on hand. This is not even updated. This is as of September 2024. This is 400 billion right now, I think. So he's selling like crazy. He has almost half a trillion in cash with Berkshire. And a lot of people don't get this, but when Warren Buffett was buying bonds in 2008, or prior to 2008, he contributed towards yield conversion, right? Because he said here in October 2008 that he had previously owned nothing but US government bonds. What happens when he buys US government bonds? The yield goes down because the price goes up on the bonds. And in this case, a 1 month to a 1 year period would be a T-bill, a 1 year to a 10-year period would be a T-note, and a 10-year to a 30-year period would be a T-bond. If he's talking about US bonds, he's talking about 10 to 30 year, which pushes down the long-term interest rates below the short-term interest rates, contributes towards a yield conversion, predicts a recession. So people's billionaires' financial positioning, such as Warren Buffett, or Stanley Druckenmiller, Paul Tudor Jones, Ray Dalio, they tell you what they think is going to happen based off of financial positioning. Okay? And then he says it, this description leaves aside my Berkshire Hathaway holdings, which are all committed to philanthropy. Right? So this is even with his company, which is committed to philanthropy. Anyways, going back to what we were talking about. So US GDP is 30 trillion in 2025. Market cap to GDP was at 210% almost. Right? Do you think the stock market then has gone from 20 trillion in market cap in 2015 to 60 trillion today? Because, well, not today, but as before this recent drop, maybe a month ago. Because the central bank has expanded their balance sheet by 2.2 trillion, 2.3 trillion. No. Most of this doesn't even increase empty money supply. Again, the way the Fed's balance sheet works is like this. They're only allowed to buy treasuries and mortgage-backed securities, which are assets that are guaranteed by the US taxpayer and the US government, according to the Federal Reserve Act of 1913. When they buy from the non-bank entities, it increases empty money supply because they buy bonds from people like you and I. Therefore, we get money. They create bank reserves. They're not quite literally printing money, but they're creating bank reserves. They buy something with those bank reserves. That increases empty money supply. Okay? When they buy it from the banks, it does not increase empty money supply. So the Fed's balance sheet has gone up 2.3 trillion in the past 10 years, while the stock market is up over 40 trillion, from 20 trillion to 60 trillion in market cap. And 70 to 80% of this does increase empty money supply. So let's say 80%, roughly 1.7 trillion out of these 1.3 trillion, 2.3 trillion of a balance sheet expansion has increased empty money supply. The central bank only accounts for 14 to 18% of empty money supply growth. 82 to 86% is commercial banks lending money into existence. You go down to a bank, you ask for a loan, and there you go, right? So that's how the Fed's balance sheet works. Also, they're only allowed to do QE when the Fed funds rate is at 0%. Okay? It's the emergency tool, right? QE and YCC, quantitative easing and yield curve control. So I wanted to go over this real quick. Is there anything else I wanted to go over? I don't think so. Actually, no, I want to go over the history of QE real quick. So a lot of people talk about when we get QE, that's going to be super bullish for the market. First of all, look at how the market has performed with QT. If your idea, right, is that QE is really bullish for the stock market, well, here they have done over $2 trillion of QT, right? Roughly 2.2 trillion currency units have been deleted out of existence, but the stock market has gone parabolic. Same thing right here. The stock market went up there in QT. Where's the correlation? You might say, but look, long term everything is gonna. Well, you can say that with a lot of things. You can say that Bitcoin is correlated to gold. It's not. They're inversely correlated. Anyways, let's go back and look at the history of QE. Okay. So here you have the S&P 500, and first we have to look at QE1, okay, which was right here in November of 2008. Which, if we just bring up the history of QE, quantitative easing 1 was in November 2008. Okay. From that point, the stock market fell late November 2008, another 25%, because as it says here, in late November 2008. Okay, QE4 was in COVID. More specifically, it was the emergency meeting. QE 700 billion Fed 2020. March 15th, in emergency move Sunday, right? The Federal Reserve cuts rates to zero and launches massive 700 billion QE program. The market, the day after, again, emergency meeting on the Sunday. This is Friday, this is Sunday. It opens up Sunday, the market tanks the next day, down 11% or so, and goes down another 18.5% from when QE is announced. What bought on the market was the CARES Act, okay? So you can say, well, but look on the right side of the chart. But it's not QE. It was the CARES Act, the stimulus checks, which is very different. Because when you're doing QE, you're giving money to the people who are likely to go and buy assets. When you're doing QT, you revive. Well, it's not about. I mean, you technically are. You're reviving the economy because you're giving the average consumer that likes to spend a lot of money directly, right? With stimulus checks. So it's very, very effective for reviving the economy. Whether it's healthy or not in the long term is a completely different question. But it is effective to do the CARES Act, as in giving people stimulus checks because it revives the economy. But QE, you can't really point towards that, right? Also, let's look at the first bank, which was Bank of Japan that introduced QE. And I've gone over this before, but a lot of people don't understand the history of QE. The Bank of Japan was the first first central bank to introduce QE after the stock market had fallen by 66% from December 1989 until March 2001. And on March 19th, 2001, the Bank of Japan introduces QE. Okay? They call it ineffective. The Bank of Japan had for many years and as late as of February 2001 stated that QE is not effective and rejected its use for monetary policy. QE begins, the markets fall another 50% for 8 years. That's the history of QE. Let's go over one here from Trump as well. Okay? Trump, there could be. Well, let's just listen to him say it instead of me reading it.
You said, look, we're going to have a disruption, but we're okay with that. Is that what you meant? The stock market going down was the disruption? What other disruption were you alluding to?
Look, what I have to do is build a strong country. You can't really watch the stock market. If you look at China, they have a 100-year perspective. We have a quarter. We go by quarters.
That's true.
And you can't go by that. You have to do what's right. What we're doing is we're building a tremendous foundation for the future.
Again, in 1930, when the Dow Jones collapsed into Great Depression, and just look at the chart. I mean, it doesn't matter what my opinion is. Just look at the chart. These returns are very absurd. Okay, you've only really seen run-ups like this in the stock market before very bad times. Right here, right here, right here, and right here. Okay, this led to the Great Depression 90% down. This led to the Great Inflation 50% down in nominal terms, but adjusted for inflation, it was about as bad as the Great Depression, which you can see right here. Okay, these are the inflation-adjusted returns. This is the normal Dow. This is the inflation-adjusted Dow. Okay, from 10K down to 2.5K, a 75% drop. All right. Here you had tariffs, and people blame the Great Depression on tariffs. They were implemented in June 1930, right here, June 1930. June 1930. From that point, everyone blamed it on the tariffs. The stock market fell 85%. You had the Spanish flu in 1920, you had COVID in 2020. You've had a credit bubble right now, and you've had it back here too. You just even look at the price action. Ascending, well, in this case, higher highs and lower lows, expanding volatility into a massive credit bubble. Boom, collapse. Expanding volatility, higher highs, lower lows into a massive credit bubble, right? And the returns right now are even more absurd than they were back here. This was about a 477% return. This bubble is even crazier, right? And if Warren Buffett says that you're playing with fire when you're approaching 200% market cap to GDP, we had 207% right before the market dropped a little bit now. I mean, you can think he's stupid all you want. You know, he has a lot of cash. Maybe he's just really dumb. Clearly, he knew about 2008 beforehand because he owned nothing but US government bonds. I'm just saying, there's a lot of warning signs here. And what you're doing is you're basically betting against Warren Buffett. Because every single warning sign that he could hint towards is present. 200% plus market cap to GDP. He has half a trillion almost in cash now with Berkshire. But again, it's not updated because this is updated as of September 2024. But he sold more since then. I'm just saying, doesn't look good. Here we have the tariffs that they're blaming this on with Trump, right? Here it was Herbert Hoover's tariffs. Anyways, that's all for this video. Take care. Peace.